Happened at exactly 4 a.m. Eastern. Total liquidation. 1 minute, silver is breaking resistance, clawing its way past $80. The next, eviscerated. This wasn't natural selling. This wasn't profit-taking. This was a coordinated algorithmic execution. The CME just changed the rules in the middle of the game, and if you weren't watching the overnight futures, you woke up to a crime scene. $3 billion in paper silver vanished in 17 minutes. They didn't just tap the brakes, they ripped the steering wheel off, and they are praying you don't notice what happens next. Look at the charts right now. Do not look away. What you are witnessing is not a market correction. It is a desperate containment breach. For the last 3 weeks, we watched the momentum build. We saw the shorts sweating. We saw the physical inventory draining from the vaults in London and Shanghai. The pressure cooker was whistling. The price hit $78, then $79, and finally briefly breached the psychological fortress of $80. And then the hammer dropped. We are calling this the margin shock. It is the oldest trick in the paper manipulator's handbook, and they just played it with maximum aggression. They didn't use supply to drop the price because they don't have the supply. They used leverage. They used the rule book. Here's the reality of the situation. The fundamentals of silver have never been stronger. Industrial demand is eating supply alive. Solar panels, EVs, AI defense tech, it's all swallowing silver. But the price you see on your screen, that dropped 12% in a heartbeat, that is the paper price. That is a ghost. I'm seeing reports coming in from traders who were locked out of their platforms right as the volatility spiked. I'm seeing stop losses hunted with surgical precision. This drop was engineered to wipe out the longs, collect the premiums, and reset the board before the real shortage makes the news. They want you to look at that red candle and feel fear. They want you to think the rally is over. But I am telling you, based on the volume data I am looking at right now, the war has just begun. They won the battle at 4 a.m., but they have exposed their greatest weakness. They are terrified of $80. And now we know exactly why. To understand why you got wiped out, or why the price plummeted while you were sleeping, you have to understand the weapon they used. It's called a margin hike. Let's get technical for a minute because your financial survival depends on understanding this mechanism. The COMEX, and the futures markets in general, are a casino built on leverage. Traders aren't buying silver with full cash. They are putting down a deposit, a margin, to control a massive contract of silver. When silver goes up, the banks and the large institutional shorts start losing billions. They are on the wrong side of the trade. In a free market, they would go bankrupt. They would be forced to buy back real metal to cover their bad bets, sending the price to the moon. That is a short squeeze. That is what we were waiting for. But this is not a free market. The exchange, the CME, has the power to arbitrarily raise the margin requirements. They can wake up and say, to hold this position, you now need to put up 20% more cash, right now, immediately. That is exactly what happened. When they hiked those margins, thousands of speculative traders, the weak hands, didn't have the liquidity to cover the new requirement. Their brokers issued an instant margin call. When they couldn't pay, the broker automatically sold their position. Now imagine thousands of sell orders hitting the market simultaneously, triggered by a computer, not by human sentiment. It creates a cascade, a waterfall of selling. The price drops, which triggers more stop losses, which triggers more margin calls. It is a self-fulfilling prophecy of destruction. And who is sitting there at the bottom waiting with a basket to catch the falling price? The very same entities that were short, the bullion banks. They use the margin hike to flush you out, force the price down, and then they cover their shorts at a profit. It is a wealth transfer from the retail investor to the institutional giant. I looked at the open interest data this morning. The amount of paper silver traded during that drop exceeds the entire annual mining production of the planet. Think about that. In less than an hour, they traded more silver than exists in the ground for an entire year of mining. Does that sound like a legitimate market discovery of price, or does that sound like a crime scene? This was a tactical nuke deployed to defend the $80 level because they know, statistically and mathematically, that if silver holds above $80 for 3 consecutive closes, the algorithm breaks. The derivatives bubble pops. They had to reject $80 at all costs, even if it meant breaking the illusion of a free market. But here is where the narrative falls apart for them. Here is the glitch in their matrix. While the spot price, the paper price, was nosediving, I was on the phone. I called 3 major wholesalers and checked the inventory of 5 of the largest online bullion dealers. If silver truly crashed, if nobody wanted it, if the value plummeted 12%, you would expect dealers to be flooded with inventory. You would expect premiums to drop. You would expect a fire sale. I found the exact opposite. One major dealer told me, quote, "We aren't lowering our physical ask price by a single cent. The paper price is fake." Another told me they have a 6-week wait time for monster boxes of Silver Eagles. This is the divergence we have been warning you about. We are witnessing the decoupling of the paper market from the physical market. The CME can smash the digital price to zero if they want to, but try to walk into a shop and buy an ounce of silver for that price. Good luck. The premiums are exploding. The spread, the difference between what the screen says silver is worth and what it actually costs to hold it in your hand, is widening to historic levels. This indicates a system in critical stress. When the paper price drops, but the physical price holds or rises, it means the smart money knows the game is rigged. The smart money is draining the physical vaults while the paper hands are folding. I'm seeing reports of force majeure clauses being whispered about in industrial contracts. This means suppliers are telling tech companies, we cannot source the silver at the contract price. Why? Because nobody is selling real metal at these fake paper lows. You need to understand the psychology here. They want you to look at your portfolio and feel despair. They want you to sell your physical stack back to them. Do not fall for it. The paper price is a tool of misdirection. It is propaganda. The reality is in the vaults. The COMEX registered inventory, that is the silver actually available for delivery, is hovering at dangerous lows. If just a fraction of the people holding paper contracts stood for delivery today, demanded the actual metal, the COMEX would default by lunchtime. The margin shock at $80 wasn't a show of strength. It was a panic button. It was the desperate act of an entity that is running out of physical ammunition and has to rely on paper bombs to keep the enemy back. We have seen this movie before. History doesn't repeat, but it rhymes. And right now, it is screaming. Go back to 1980. The Hunt brothers. Silver was skyrocketing. The establishment was terrified. What did they do? They changed the rules. The exchange simply announced, buy orders are no longer allowed, liquidation only. They raised margins to 100%. They destroyed the price overnight, not by market forces, but by administrative fiat. Go back to May 2011. Silver touches $50. The same thing happens. 5 margin hikes in 9 days. They bludgeoned the price down with a baseball bat. They are using the 2011 playbook to fight a 2026 reality. But the variables have changed. In 1980 and 2011, the U.S. debt was manageable. The BRICS nations weren't buying gold and silver hand over fist. The dollar was the undisputed king. Today, the U.S. debt is spiraling vertically. Central banks around the world are dumping treasuries and buying hard assets. The margin shock works short-term, but it has diminishing returns. Every time they smash the price, the East, China, India, Russia, uses the discount to strip the West of its remaining physical gold and silver. I look at this chart, and I don't see a crash. I see a coiled spring. Every time they compress the price down with these artificial margin hikes, they are adding kinetic energy to the inevitable explosion. They are trying to paint a picture of weakness, but look at the volume. Look at who is buying the dip. It isn't retail panic buying. It's sovereign wealth funds. It's industrial giants securing supply chains. They know the paper game is ending. The rejection at $80 was violent because the resistance is thin. Once we clear 80, and we will, whether it takes a week or a month, there is no ceiling. The vacuum above $80 is massive. They had to defend this line because it is their last line of defense before triple digits. So what do you do now? You've watched your portfolio take a hit. You're angry. You should be. But you need to convert that anger into clarity. The system just showed you its hand. They showed you that they are willing to burn the furniture to heat the house. They are willing to break the integrity of the market to save the banks. This is your signal. This isn't the time to sell. This is the time to recognize that the paper price is a lie. If you hold physical silver, you hold the truth. If you hold paper silver, you hold a promise from a liar. The shockwaves from this margin hike will settle. The weak hands are gone. The leverage has been flushed. The market is cleaner now, lighter and ready to move. Don't let them shake you out. Don't let a CME rule change dictate the value of your wealth. They can print dollars, they can print paper contracts, they cannot print an ounce of silver. Watch the premiums, watch the vault withdrawals, ignore the spot price noise. The $80 rejection wasn't an end. It was a confirmation that we are right over the target. I'm going to be tracking the dealer inventory numbers closely over the next 48 hours. If I see the shortages I expect, I'll update you immediately. Keep stacking, hold the line, and do not let them take your real money in exchange for their paper promises.